What if I told you that just $100 a month, less than what many Americans spend on coffee, streaming subscriptions, or takeout, could potentially grow into hundreds of thousands of dollars? Sounds impossible, right? Before getting started, please like the video, subscribe to the channel, and press the bell icon so you don't miss any future videos. But here's something even crazier. Millions of people never become wealthy not because they don't earn enough money, but because they underestimate the power of time. Today, we're going to discover exactly what happens when you invest just $100 every month for 30 years. We'll look at real historical market data, reveal the biggest mistake investors make, and uncover why starting today, even with a small amount, could be one of the most important financial decisions of your life. And trust me, the final numbers might shock you. One of the biggest myths is that you need a lot of money to become wealthy. Social media often shows millionaires driving luxury cars and making huge investments, creating the impression that wealth is reserved for high-income earners. But the truth is far less exciting, and far more powerful. According to decades of historical stock market data, consistent investing beats trying to get rich quickly almost every single time. Let's imagine two people. Sarah starts investing $100 every month at age 25. She doesn't have a high-paying job. She simply invests consistently. Meanwhile, Mike decides to wait until he's financially ready. He starts investing later, but he contributes more money each month. Who do you think ends up with more money? The answer might surprise you. Albert Einstein allegedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the idea remains true. Compound growth means you don't just earn returns on your money. You earn returns on your previous returns as well. Let's use a realistic example. Historically, the U.S. stock market, represented by broad market indexes like the S&P 500, has produced average annual returns of around 10% before inflation over long periods. If you invested $100 every month for 30 years and achieved an average annual return close to historical market performance, here's what happens. You would personally contribute only $36,000. But thanks to compound growth, your portfolio could grow to approximately $200,000 or even more. Think about that. You invested $36,000. Yet your money potentially created more than 5 times that amount. And that's where the real magic happens. Here's the part that surprises almost everyone. The majority of your wealth isn't created during the first 10 years. In fact, during the early years, progress feels painfully slow. After 5 years, many people become discouraged because their account balance still seems small. After 10 years, they start questioning whether investing is worth it. But then something incredible begins to happen. The compounding curve starts accelerating. Your money begins working harder than you do. In many cases, the growth generated during the final 10 years exceeds the growth from the previous 20 years combined. This is why financial experts often say that the biggest mistake investors make isn't choosing the wrong investment. It's quitting too early. Let's look at a historical example. Imagine someone who began investing $100 per month into a diversified U.S. stock market fund in the early 1990s and continued investing through every major crisis. They would have experienced the dot-com crash. They would have lived through the 2008 financial crisis. They would have seen the COVID market crash. And despite all those events, history shows that long-term investors who stayed invested were eventually rewarded. Why? Because successful investing isn't about predicting every crash. It's about surviving long enough for compound growth to do its job. Now let's return to Sarah and Mike. Sarah invested $100 per month starting at age 25. Mike waited 10 years and started investing at age 35. Even if Mike invested significantly more money every month, Sarah could still end up with a larger portfolio because she gave compounding something incredibly valuable. Time. This is perhaps the most important lesson in personal finance. The amount you invest matters. But when you start investing often matters even more. Every year you delay investing is something you'll never get back. So, what happens if you invest $100 a month for 30 years? You probably won't become an overnight millionaire. You won't wake up rich next week. But you'll gain something far more valuable, the power of time, consistency, and compound growth. Because wealth isn't usually built through luck. It's built through small decisions repeated over decades. And perhaps the biggest takeaway is this. The best time to start investing was 30 years ago. The second best time is today. If you enjoyed this video, please give it a like, subscribe to the channel, and press the bell icon so you don't miss any future videos. Thanks for watching, and I'll see you in the next video.